Every time a transaction happens in an organization, it can only be allocated into one of 5 different categories. So these categories, the first one is assets. These are things that we own and we use these to run our business, to operate our business. So examples of these are land and buildings, our equipment, our machinery, our computers, our inventory that we have in our businesses, in our stores, the money that we have in the bank is an asset, and also any money that is owed to us from our debtors, from our accounts receivable for inventory that we've sold on account to them. That is also recorded as an asset. Asset, things that we own and we use them to run our business. So that's the first category. The second category is our liabilities. Now this looks at all the money that we owe out of the business. So examples of liabilities are going to be things like loans, any bank overdrafts that we might have. When we buy our inventory from our suppliers on credit, it's what we call accounts payable. That's recognized as a liability. It's money that we owe to our suppliers. So those reflect the amounts that we owe out of our organization to other parties. That's our liabilities, the amount of money that we owe. The third category, similar to liabilities, is what we would call our owner's equity. And this essentially is the amount of money that belongs to the owners of the business, of the organization. And it's made up of the amount of money that they initially invest into the business or buy the shares for in the business. And we add any net profit that we generate as a business gets added to their equity, and any net losses that we generate as a business gets subtracted from their equity. So it's the amount of money, again, that we owe to the owners of our organization. The fourth category is what we would call income. Now, income, this looks at all the money that we earn as a business, as an organization. So primarily it is made up of our sales. This is looking at the inventory that we've sold at the selling prices that we're selling it for. Other examples of some incomes are interest received on our bank accounts, if we receive commission, if we receive royalties. That is all reflecting and showing income that we are earning as an organization, as a business. And then the last, or the fifth category, is what we call expenses. And this is essentially the costs of running our business. So these are used up during the month or during the period that we're operating and reporting on. So examples of expenses, the first one is what we would call cost of sales. And this looks at the cost price of the inventory that we've sold. Remember, once we've sold the inventory, we no longer have it. So the cost of that inventory now gets written out of our business. Other examples of expenses are going to be things like salaries and wages, rent, telephone, electricity and water, depreciation, bad debts. All of these things get used up during the month or during the period that we're operating for. So those are the 5 categories. We have our assets, our liabilities, our owner's equity, our income, and our expenses. Now, the accounting system is a science based on a science principle, and the principle that says for every action there's an equal and opposite reaction. So in the accounting system, we have 2 different sides. We have a left-hand side and a right-hand side for every single account. And the left-hand side is what the accountants call the debit side. The right-hand side is what they refer to as the credit side. So just referring to the left is debit, the right is credit, as it were. That's where the debit and credit terminology comes from. Now, every time we acquire more assets, they get recorded on the left-hand side or the debit side. Every time we're paying out expenses, again, these are recorded on the left-hand side or the debit side. On the right-hand side, if we're borrowing more money or if we're increasing our equity, that gets recorded on the credit side. Or if we're receiving or earning incomes, those also get recorded on the credit side. So we have our assets on the debit, our liabilities on the credit, we have our expenses on the debit, and our income on the credit side. That is the only space where those transactions can get recorded. So that is the framework as it sits up: 5 categories: assets, liabilities, income, expenses, and owner's equity, and 2 sides, a debit side and a credit side. Now, when we get to the end of the period that we're reporting on, what we would do is we would take the income and the expenses out. All of the income and expense accounts gets pulled out, and those get summarized into a financial statement that we call the Statement of Comprehensive Income. This is also traditionally known as an income statement or a profit and loss statement. And it shows us what did we earn, the income that we brought in, minus all of the expenses, or what did it cost us to run that business. And at the bottom, we get what we would call our net profit or net loss. So a simple illustration of what a statement of comprehensive income will look like. We'll start with sales, then we'll subtract our cost of sales, and this will show us what we call gross profit. That is essentially the profit that we've made on the buying and selling of product. Very important figure for us in retail. It shows us how much money we've made purely on the buying and the selling of that product. We would then add any other income that we might have earned, subtract all of the other expenses or costs for running the business, and right at the bottom we're going to have our net profit, or if it's a negative figure, our net loss at the end there. Now that net profit or net loss, that belongs to the owners of the business, and that gets added onto their equity in our statement of financial position. So the net profit or net loss that we generate right at the bottom in terms of the Kuba game, the team or the player with the highest net profit is going to be the winner of the game. So income and expenses go into our statement of comprehensive income. Then we take our assets and our liabilities and equity, and those get summarized into a statement called a statement of financial position. Now, every single time a transaction happens, it impacts our statement of financial position. So the statement of financial position, the way that we would put that together, at the top we would have all of our different assets, the things that we own. So we're going to have our investments up there. We're going to have any machinery we might have bought, any vehicles that we might have bought. That is what we would call our non-current assets. Now, non-current assets refer to assets that are not going to be turned into cash within the next 12 months. We then have a category that we would call current assets. Now, these are assets that we are likely to turn into cash in the next 12 months. So that is made up of our inventory, our accounts receivable, and our cash or our bank. So we would add all of our assets together, and we're going to get a total for our total assets in our business. We then list our equity and liabilities at the bottom section of the statement of financial position. And we start off with our equity. This looks at our share capital, how much was invested in the business to start with. And we would then add any net profits or subtract any net losses that we made. And that will give us what our equity is worth, what is owed to the owners of the business. We then list the rest of our liabilities. We'll have our non-current liabilities, those liabilities that are going to take longer than 12 months to repay, which in our example here is going to be our loans. And we would then have our current liabilities, which are going to be the liabilities that are going to be paid within the next 12 months. And that is going to be our accounts payable. So once we've listed all of those, we would add those down and we would get a total for our total equity and liabilities. Now, our total assets should equal our total equity and liabilities. That way we know that everything balances and we can validate that the information is correct in our financial statements.